This is part of the what is called logistics execution. So as part of the finance refresher for inventory management, I want to explain to you changes that are affecting mainly the process of invoices that are linked to PO. So if we are going to open now another slide that will try to remind you what happens before you process an invoice that has a PO. Okay. If you are experiencing, as I said, if you are experiencing problems with the sound, do not worry, because you will get the recording. Okay. If you are experiencing problem with the sound, also contact your IT service so they can support. So I was saying that we are going to review the invoice process when there is a PO in place and how this is impacting the GLs eventually. So you have to put your mind on this context. So we are going to discuss accounts payable pre-processes and see how this is impacting the accounts or how it used to be. So let me just 1 second. Give me just 1 second. So okay, all right. So I want to open one slide that has the FI posting that we used to have. Okay, so 1 second. Okay. 1 second. Okay, I hope you're seeing my screen. Someone is talking to me. One moment so I can see the chat also. So 1 second. Give me just 1 second. If you can hear me, please click on the green check because it looks like there is an audio problem. All right, sorry for breaking it. For that, I was talking to one of my colleagues, so he can assist you with the audio if you are experiencing audio problems. All right, so let me just continue. I will not share the screen so I can write as well. I mean, I will not put the slide on full presentation so I can write. So if you remember for foundation, we could have a scenario like the following one. If you remember from foundation when we were acquiring either goods and services, all right, we could have a PO for your goods, for instance, and in the PO we will have the account assignment, and immediately after there is a good receipt, we will get the debit on expense account. So do you remember when we have a PO for goods, for example, in foundation, we will be acquiring, for example, one item that would be valued $100. As soon as the good receipt was processed, we had the debit going to expense account and the credit going to GRIR. So do you remember this posting? If you are following me, please click on the green check so I can get feedback. All right, so what I'm saying is that before, when we were purchasing goods or services in foundation, we had debit to expense account, credit to GRIR, right? And then second step, we used to have the debit on GRIR and then creating vendor account, right, when the invoice was processed. That was just normal. Now, what you need to keep in mind, this one was applying to either goods or services. And this is still 100% valid for services. So still, if we are acquiring services, we will have, at the moment that the service entry sheet is processed, so I can write here service entry sheet. At the moment of the service entry sheet, we'll have debiting expense account and we'll have creating GRIR. And at the moment that the vendor invoice is processed, we'll have debit and GRIR to clear it and credit on the vendor account. That will be clear later with the payment process. But what happens now after the commissioning of Galileo and introduction of inventory management module in Umoja or SAP for us, the point of the goods receipt is not always behaving in the same way. All right, so this is a change that you must be aware of, and you need to consider the following if this is new to you. So if I take, let's say, maybe another example, all right, what would happen is the following. So if we are now, so as I said, for services it will be still the same. For goods, we need to let's say we need to consider that now we can acquire items in two different ways. We can acquire goods for consumption, let's say from the system perspective, and we can acquire items for inventory. So if I add a new slide so I can write something there for you. Now, when we acquire goods, it's not like it was before, because now we can have items called for inventory or consumption. So, and this is an important difference, because when we acquire goods for consumption, the posting will be still the same that we had in foundation. So if we acquire goods, or if they acquire goods for consumption, at the moment of the good receipt, we will have debit to expense account, credit to GRIR. But if they acquire goods for inventory, so items goods for consumption are still as in foundation. Okay, so that's fine, and that's not difficult to remember because it's already something that you already know. But if we acquire goods for inventory, then the posting will not go to expense account right away. So there will be no debit to expense account directly. Now there is something about terminology that you need to understand in this context. When you're talking to procurement people or inventory or requisitioners, when we are talking about inventory in the shopping cart, it's something that is called direct material. So this is new terminology for you. All right. So this is something that is important. It's important for you. Now we have this scenario that was not in foundation. So when you were trained, you didn't know this because it happened later after the commission of Galileo. So when they are acquiring shopping carts, when they are raising shopping carts, they can raise shopping carts for direct material, and this one will not debit the expense account. Okay. So what would be the posting on this type of scenarios? And this is something that is new to you. So will be the following. Okay. So we'll have the shopping cart, and shopping cart will have no impact in FI, right? We'll have the purchase order, and we'll have no impact in the accounts. It will be committed funds, but will have no impact in the accounts. Now let's imagine that we are acquiring something, and there is a associated freight cost that we manage maybe in a different purchase order or as a different service. So let's go through this little scenario and see what is actually going to happen here. Okay, so we have, let me just remove this because it's from a previous example. I don't want you to get confused. 1 second. So you have shopping cart, and we have a purchase order. And then what is the purchase order for? It's direct procurement. So it's a direct material, which means that they are acquiring for inventory. Okay, and we are acquiring for inventory, and We are acquiring only one item in this case, and the value of the item is only $100. Please allow me to use this very cheap example, but I think it will be better for you to understand. In the case, so we are acquiring only one item, and there is also freight service that it will be $8, and it's paid with a different PO or in a different line as a different service. So let's imagine that we are processing first the service entry sheet for the freight. And as I said, for services, we are still in foundation mode. So we will have, if the service is, freight service is $8, we will have $8 going to the expense account and as a debit, and as a credit, $8 going to the GRIR, which is normal, right? And then we will have invoice process, and we will clear GRIR, and we will pay. So are you following me? Can you please confirm that it's clear, this scenario is clear, you understood? We are acquiring one item, and we have freight services of $8. Can you please click on the green check on your participants panel to see if you understood? Thank you. For the people that joined later, please go with the mouse to the top of the screen that you are watching and click on participants panel so you can see also the options to give me feedback. All right, so please click on the green check if it's clear. So we continue with the scenario. We are acquiring this item, so we process or they process the service entry sheet, and we have $8 that went to the expense account for the freight services. Now, at the moment of the good receipt, this is a big difference compared to what you learned before in the LP Academy. So what happens when the good receipt is processed and the item was for inventory is that the amount doesn't go to expense account. So if we are acquiring 100 items for the value of $100, we will have $100 plus 8% going to inventory account. And listen, I'm saying 8% and I'm not saying $8. Why? We are sending $8 to 8% to the inventory account because we are adding what is called the standard associated cost. So for peacekeeping will be 8%. So what we are actually for inventory items will be 8%. Then for fixed assets, it will be 20%. And this is something we will discuss maybe tomorrow or after tomorrow. So when the good receipt is posted, we are not debiting directly the expense account. We are debiting the inventory account for the amount of the item, plus 8%, which is a standard associated cost. So we are, let's say, capitalizing, or we are adding to the inventory account the value of the 8%, which is other type of associated cost. Is that clear? Then if this 108 goes to inventory account, so we'll be to GLs starting with 17. To GRIR, we will send only 100 as a credit, because this is the amount that we are going to be paying to the vendor for the item. And then the other credit of $8 will go to expense account to net, or let's say to transfer this amount from the expense to inventory. So at the end of this process, we will have an inventory value of $108, and we had paid 100 to the provider of the item and $8 for the service. Okay, is this clear? Do you understood more or less? So the point is that whatever we acquire, we are debiting the inventory account as as the amount plus 8%. Now, in general, some of you are going to be a bit concerned because freight service might not be 8, right? Freight service might be 10 in some cases, or it might be 5, or it might be very difficult to estimate if the freight service is shared among different POs or among different items from different natures. So what you need to understand is that what we are adding to the inventory account is not the actual cost of the freight, but is a standard associated cost and is estimated in a way that we consider that in average it would be 8%. Now this number here would be re-estimated once they start analyzing the freight services, and maybe eventually they may be customized or based on recommendation from auditors or UNHQ decisions. We may move to a different model if this is not completely, or if it's not accurate enough. But what I want you to understand is that regardless the eventual cost of the freight services, the posting of the good receipt when items are going to inventory is the following. It's basically the price, the acquisition price of the item plus 8% will go to inventory. Okay? Is that clear? If you want me to repeat, please, you can click on the red cross. So I try to explain it in a different way. And I see that there are some questions. So there is one question that maybe is interesting for you. It says, is the 8% automatically added by Umoja? Do we need to reconcile the standard 8% and actual freight at the year end? So those are two different questions, and I think may be useful. So this 8% is added automatically by the system. So you will have a PO for 100, and if you go to the good receipt and you analyze the posting, you will get confused if you don't know this, because you will see that the price of the PO is 100 and the debit on the inventory account will be 108. So yes, it's automatically posted. So you will see the debit, the credit on expense on the particular GL for freight services, and the credit on the GRIR. So it's automatically. Someone is asking if you will need to reconcile at year-end the accounts manually. Now I haven't seen the year-end instructions, so I cannot tell you anything about that. But this is also a good question that maybe we can forward to UNSQ. All right. In theory, there will be an analysis of this expense account to see if the percentage is properly estimated, and I know that this in SAP could be customized even by plant. So maybe the associated cost in MONUSCO will not be the same one as in a different mission in Unifield, for example. But in principle, right now, it's how it is configured. It's as I'm explaining to you. So do not get confused if you see the good receipt creating an expense account. It's basically the idea is that we'll be netting off the freight services that are processed by a different transaction. All right. So okay, there is another question about it. So the question is, does it mean that 8% of 20 will be in every shopping cart or PO for inventory goods? Yes. So the point is, if you let me go back, we said this one is from foundation, and then I said you can have goods for consumption and goods for inventory. So for DPKO and peacekeeping right now, instructions for procurement is that basically everything has to be acquired for inventory. Okay, there are some exceptions to that, but I don't want to get into it. But in general, as a general rule, instructions that we are receiving is that all shopping carts for goods should be raised for inventory. So this is going to be the most common case for you. And yes, it means that whenever you have a shopping cart for goods as and submitted as for inventory, you will have either 8% if you are in peacekeeping or 20% that is going. So I don't want to touch the fixed asset part, but if we are in a fixed asset scenario, instead of the inventory account, we will be touching an asset account, right? So, and instead of 108, will be 120. So for fixed asset, it's 20% as a standard assumed cost. For inventory items, it is actually 8%. Okay. Can you please click on the green check if this is more or less clear, or I need to make some other example? If it's click on the green check on the participants panel if you understood the difference between the good received now and the good received before. All right, thank you. Now there is a good question about these credits. I mean, there is a good question about the credit on the expense account. So whenever we will process in the goods received, you will have the credit on an expense account. This expense, I'm saying here expense, but here you will have two different GLs, right? You will have the actual the expense account for the services. In the case of the freight services, that may be a different one, and this one will always be the same one. So this credit goes here because we are actually adding to the inventory account 108. So we don't want to have double when we are issuing this out to for consumption. When we are issuing this out of inventory, we don't want to track double expense. So this credit goes there because in theory and ideally, if we are in average, if we are assuming or ideally that the freight services was 8, this one will be netting off. Now it may be 5, it might be 6, it may be 10, it may be 12, but we are working under the assumption that this percentage in average it's correctly estimated, and that is the purpose of the 8%. So now, what if? So now some of you should be confused because if you remember, we used to say that the determination of the GL in this scenario was based on product and product category. So if you remember from foundation, we used to say, how does the system know what GL needs to post? And we had a discussion about the product ID that we used to have in the shopping cart. And then we used to say, from this product ID, the system will create, we'll have to check the product category. And then from the product category, we have the GL that is determined by the system. But now it's a bit different. So now you will have, let's say, the product ID that is in the shopping cart. All right. And now this product ID has, as you know, something that is called product category, right? So 1 second, I just need to add a bit of text where I'm explaining. So 1 second. Okay, it's fine. I will do it in this way. So we have also a product category, right? So let me make bigger this arrow so you can see it. You can see it better. Okay. Okay. So we have product ID in the shopping cart, and this is pointing to a product category. And then from the product category, we used to have the determination of the GL. Do you remember? This is nothing new for you. You should be knowing this. And then from the product category, the system was determining what is the GL account that normally was expense account. All right. Do you remember this from foundation? Could you please click on the green check if you remember? From foundation, that this is the determination of the GL account based on the product. So there was a shopping cart, acquisitioner should select the right product ID, the system will get the product category, and from there it will determine the GL account for expense. Now, since we did the commission of Galileo, there are more than one GL for the product category. So you may have an expense account, or you may have a GL account of inventory. Okay, you may have an inventory account. So expense account will be started with 7, while inventory account will be starting with 17. Okay. So now you have these two scenarios. There is a third one that we'll cover in a few days. That is when it's a fixed asset, right? But this one is, in general, is another change that you might be aware, account determination. I'm sorry that I'm building a slide on the fly, but I just delivered recent training. I didn't have all the time I would like to prepare these sessions, but still, I hope it's going to be useful for you in any case. And there is a very good reference material developed by Chris Vickery that I will share, and I will show to you how to get access to. So it will be fine. I'm just using these slides to explain it better. So that this makes sense, I'm going to ask you again to click on green check if you understood this slide, and if you agree with it. I mean, if you get the idea and why there is a change in the system. Is this clear that now with the product ID we'll have to go to account 17 or 7? So how does the system knows where to post? It will depend on the type of shopping cart that has been raised. If the shopping cart that we had is for inventory, so if this is for inventory, so or in shopping cart is called direct material. So if the shopping cart is created with the option direct material, the posting will go to inventory. If the shopping cart is created for consumption or is for services, it will go here. Now what happens is that for peacekeeping, now most of the shopping carts are created as direct material. So let me just send a message to everybody through the chat. Sorry, we are recording, and we will send the recording after the session. Okay, so I think that explanation was it's more or less okay. There is another question about the 8%. Okay. Yeah, there is a question about if we are overestimating the inventory by adding 8%. So if the question is about the question is from Hamid, thank you for the question. If you are questioning the 8%, particularly, this is something that will be seen, I guess, at the year-end closing, and it will be re-estimated. The decision of adding 8%, it's based on an estimation of the different associated costs. So normally to inventory or for fixed assets, you should be also capitalizing the associated costs. So the value of the item that you acquire in one place, it's higher once you receive it in the mission, because you according to IPSAS, you can capitalize the associated cost. But a decision was taken, instead of capitalizing the actuals, we are going with the standard associated cost. So that is why we are adding the 8%. Okay, right. So this is about the account determination and the standard associated cost. So what does happen then? When does the when is the expense recognized? Because if you remember, one of our messages in Foundation was that based on delivery principle, the posting to the expense account was happening on the delivery principle, based on the delivery principle at the moment that the goods received was processed, or when the service entry sheet was processed. This is not true anymore. So the recognition of the expense for services happens when the service entry sheet is posted, which is fine, it's correct. But for goods that go to inventory, there is a new transaction that you need to know, which is called goods issue. All right. So if I continue with this example that I was building here, we have in inventory 108, and then if the items are supposed to be consumed, there will be another transaction, which is called goods issue. So when someone in a technical unit or in a self-accounting unit, or whatever, needs this item that we acquire for $100, okay, we will someone from inventory will need to issue the item out of inventory. And this one is a new transaction that didn't exist in Foundation, and it's called goods issue. What will the goods issue? Sorry, we are missing here this 5. I missed it somewhere. What is actually the goods issue doing in the system? So it's basically crediting the inventory and debiting expense account. So if we enter here the next posting for the step number 5, what would be the posting? So we will be, if we are issuing out this element, we will be crediting inventory account for 108 in this scenario, and we will be debiting the expense account for 108. That's it. All right. So now the situation would be similar to what happened in Foundation, but now we have 2 steps. So we have a value in inventory, and then when we are processing good issue, so when we are when we issue out materials from inventory, then it's when we are going to debit the expense account. I mean, this is in a nutshell, and now I'll give you some more information because there are some particularities. So is this clear? This is a scenario of how we process good issue after we receive items. Could you please click on the green check if you understood? So we received an item that was $100. Then in inventory, we enter it with 108 because we are adding 8% of standard associated cost. And at the moment that we process the good issue, we debit the expense account for 108 and we credit inventory account. Could you please click on the green check if it's clear? And if it's not clear, please ask a question either in the chat or I would prefer if you ask in the Q&A panel. Very good. There is a question. So there was a question about why not to take actual instead of 8% of 20%. So the question is about why to use standard associated cost or actual, right? Now this is a decision taken by accounts division, and I guess it's happening only in a kind of transition phase, because it's not so easy. Sometimes you have purchase orders that have the freight that is shared about different items. So if you are acquiring, for instance, 10 laptops and a vehicle, and then you are paying the freight service company to bring all, you should have also that PO defined, so they are charging you by element. So maybe we are not ready yet to record the actual, and that's why it was decided. So, but this is pretty much a policy decision, and I cannot tell you exactly what are the business implications behind it. What is true is that the system is now configured with the with the standard associated cost, and we'll be adding it. And then down the road, we will see if this is a good or not a good method. And then if they apply any change into the system, I will have a different session and I will inform to you. Okay. So there is a question about when this become effective, and this was effective with Galileo decommissioning, which was actually last summer. All right. So in your missions, there are some people from inventory management and property management that are local process experts. So this is that was implemented with the commission of Galileo, right? But from my side, because I've been training you for the last years, I knew that this information was not maybe getting to you. Even though it's official and there is official information, you're going to be surprised with a good job aid that has all this information. So what we are talking now is about inventory items, okay, and how we evaluate our inventory. So when we are acquiring, we are evaluating our inventory, and we are talking about items that are not fixed assets. Okay. So I think this part is also clear. Most of you said yes. If anyone has a question, do you understand actually the part of the good issue? Because this is also something new, so you will see also these transactions. Do you understand the part of the good issue? Now I'm going to make it a bit more complicated, so please let me know if you understood the basic. All right. I think you already replied. Most of you already replied before, so it's fine. Now I have a question for you, so please pay attention. So what happens if we are acquiring instead of one item, we are acquiring 10 items? Okay. So you understand perfectly that when we are posting to inventory, instead of posting 108, it will be 1080, right? That is not a big difference. And then at the moment of the goods received, we are paying, because instead of acquiring one item, we are acquiring 10, and then everything will be multiplied by 10, right? This is normal. And this scenario is not difficult because it's only a matter of multiplying, and the price is a fixed thing, right? So, and then the expense account also will be with an extra 0, and then here we will have an extra 0. Now, but sometimes when you are acquiring from inventory, you may be acquiring at different prices. So let's imagine that this item that we are acquiring, the initial price was $100. So the price was $100. But then, and then we acquired one item at $100, as we said, and then we acquired 10 items at $100, and then we acquired all of a sudden, well, let me just make it so the number is rounded. So we acquired 10 items at $100, but then we acquire another 10 items, and then all of a sudden there is a price change, and the price is not 100 but $50. Okay, and we acquire everything for inventory. So let's imagine that there is a PO now in June, at the beginning of June, and then in July there is another PO, and we are acquiring the same type of items with different prices. Do you follow the scenario? Do you get the idea? So 10 items at $100, 10 items at $50. And then how many items we have in inventory now? So we have 20 items in inventory. Okay. What would happen for in the posting? So if we are going to simplify a bit. Okay. So we are going to remove the freight services from the scenario. So we acquired first items, 10 items. Okay. And this is the posting that we have, because 10 items at $100 is 1,000. So we are paying $1,000. We will pay $100 to the vendor. In the inventory, we enter 1,080. And now we said that we are buying also something else. So we are buying another 10 items. Okay. and their price is 50. So what would be now the amount that we have to pay? So we set 10 items at $50. So now we have to pay $500. Okay. So we will have as a credit $500. And now as a debit here, instead of 1,000, because this is only is much cheaper, we have 54, if I'm not wrong. Okay. So will be $50. Let me just open calculator, so I don't want to do any mistake here on the fly. So we have, one second, we set $50. Okay. No, $500. Sorry, $500 plus 8%. So it will be, yeah, I was missing 1 0. Sorry. So it will be 540. Okay. Now, do you agree? Please, can you please click on the green check if you are following now the change of the scenario? Now we are not acquiring 10 items, but we acquired 10 items at $100 and 10 items at $50. So the 10 items at $100, you already have the scenario from before. So we have the amount plus the 8% debiting the inventory account. Okay. And then we have the credit on the expense account for the freight service. So please click on the green check if it's clear, or I need to explain it in a different way that will help you understanding. Okay, I'm getting feedback from you. Okay, all right. If you don't follow or you're getting lost, please also click on the green check and the red cross, so I know that something is not going well. Okay, so let me rephrase. We acquired 10 items. Every item is $100. How much do we have to pay? 1,000. How much we debit on the inventory account? So 1,000 plus 8%. Why? Because we have to add 8% of the standard associated cost. This is done automatically by the system, and then we create the expense account for 80, so it will net off any freight services. Another day, there is also another purchase order, but there was a very good discount, and the items, the price of the item, instead of being $100, is $50. Of course, I'm doing this big difference so you see the difference. So if we acquire 10 items at $50 each, we have to pay $500 to the vendor. So we will have the credit on the GRIR that eventually will go to the vendor for the price of any of the item multiplied by the quantity of items. So 10 items, which price is 50, it is actually $500. In inventory, we are going to debit the same amount plus 8%, which is a total of 540, and this goes to expense account. This is fine, and I guess everybody agrees on this. Now, what happens now if in August this happened in June? We acquired 10. In July, we acquired 10. What happens in August if we need to use these materials? If someone goes to inventory manager and requests the creation or the posting of a good issue, because these items, one item needs to be used. Now I'm asking you, and I would like you to reply to me on the chat. If we now in the good issue, we want to issue out only one element, only one item, what would be the accounting, the posting? So what are we actually posting to the expense account and creating? Because as I said before, the posting was you credit inventory account and you debit expense account. But what would be the amount now if we are processing good issue for one item? What do you think would be the amount? If we take one item, will we be issuing out for 108? Will be issuing out for 54? What would be the amount? So some people, okay, Some people are saying 75, some people are saying different numbers, one item plus 8%. Yes, okay, so when people are saying one item by 8%, but the problem is here that when you have it in inventory, you don't know exactly if you are going to be issuing items from this on this. So this is a new concept that I need to introduce, and it's called moving average price. So give me 1 second. So we have another new concept that is called moving average price that was not there when we were training on an Ammaji foundation process. So moving average price. So moving average price is calculated if the moving average price is the value of one item in inventory. It's called moving average price. Okay. Don't worry if you join the WebEx late, okay? Because we are recording, so we'll send you the recording so you can watch everything. So the moving average price is the price or the value of one item in the inventory, and it's calculated considering the value of the existing stock plus the elements that we have been acquiring. So in theory, you should have to calculate, I mean, no, you should not have to calculate, but the system will have calculated the elements, I mean, the price of every element, and then considering the quantity, will calculate the average. So now we have basically, if I can show the calculator in the screen so you'll see quickly, and there is formula, and I mean, we can share with you also the, of course, the official material that is there, but this is only for the explanation. So what is the moving average price now of this item? So we have an inventory value of 1080 plus 540. This is the total value of the inventory for this stock. And we have 20 items. So the average price would be 81. All right, so some of you already replied correctly that the moving average price is 81. So when we are processing the good issue in this scenario, so basically the moving average price is the average price of these items. So what I just did is to put the whole value of inventory and divide it by the number of items. Okay, so the moving average price in this case in the system will be 81. So if I can write here with moving average price, MAP, you will see it somewhere in the reference material, moving average price is 81 USD. So the posting when we are doing the good issue will be actually debiting expense account as of $81. And we will be crediting inventory account with $81. So this would be the posting of the good issue. Okay, this will be the posting of the good issue. Now, is this clear? And please click on the green check. And by the way, thank you for everybody that is joining from the other side of the Atlantic. I know it's very bad timing, but just for your information, we are recording all the sessions. So you can watch it in a normal working hours. I'm very sorry if you got up in the middle of the night for that. Yes, I can repeat the calculation of the moving average price. Do not worry, you don't have to calculate moving average price. The system is automatically calculating this. So in the material master record, so in the master data of every material, you have the system calculating moving average price for you. So when someone from inventory management is processing good issue to remove items from stock and deliver them to the technical unit, the system is going to debit expense account for this amount and crediting inventory account automatically. I'm explaining this to you so when you see a posting in your accounts, either inventory or expense account, with an amount that does not correspond with the price of the item in the PO, do not worry, it is the moving average price. And then if you understand how it works, you can assess if the moving average price is incorrect. Because sometimes it's happening that in the shopping carts, they are selecting the wrong product ID, and then the moving average price is corrupted. So it's important that you as finance staff and finance LPs understand the concept of moving average price, because there is some situation when you have to be involved in the fixing process of wrongly evaluated inventory, and then you need to understand the concept. You don't need to calculate it manually every time, but if it happens that there is a problem, you do have to calculate it to fix the problem. And now I'll give you an example of a problem. How did I calculate the moving average price? So in this scenario, let's take these two steps. So we said, first step, we acquired 10 items, right? We acquired 10 items, and each item was $100, right? And then we had the plus 8%. So the total value of inventory after the first good receipt was $1,080. This was the value of the inventory after the first good receipt. Now, what was the moving average price on that moment? The moving average price was this divided by the amount of items. So what was the average price of an item? So if you divide this by 10, you have that at that moment, after we acquired the first 10 items, the moving average price was 108. Is this clear? Can you please click on the green check? I know this is a new concept for you, so you have to pay attention. So is this clear? After acquiring 10 items at $100, since the system is adding 8%, this was the moving average price, which is basically the price of one item plus 8%. After the second PO and the second good receipt with when more items are arriving to the stock with different prices, and this is a very simple example, but you can have stock with lots of items that are being acquired with different prices, right, as the time goes on. So after the second good receipt, then we have an inventory evaluated for this type of material that is 1080 plus 540. This is the total value of the inventory for that type of item. Is this clear? Which I'm basically adding the two elements. Is this clear? All right. I think it's fine. So what is the moving average price now? Then you have to think, how many items do you have in inventory? I have 20 items in inventory. So the moving average price was calculated by the system when the good receipt is posted or updated by the system. So the system will say, now this is the value. We have 20 items, and the moving average price is 81. So every time you are sending to expense one item, so every time you are processing good issue, the system will be sending 81. So what happens if we acquire more items? The system will be automatically calculating. So how would you calculate the moving average price of an existing stock? You will go to the GL, you will review you will fix whatever you have to fix, and once done, you will check the value of the value of the GL, so the value of the GL for that particular item, okay? And then you need to get inventory telling you how many items are there, and then you have to do that one. Okay. Someone is asking, what is the T code to find out MAP for inventory items? Now I'm going to show the job 8, and you can get it through MM03, and you will do it with the material ID. So if you go with the I'm not sure you have access to MM03, but if you have the product ID, anybody with access to MM03, which is to display master data, you enter the product ID, and there is a section there where you can see the moving average price your plant. Okay, because even the moving average price, I think, is particular to the plant. All right, you have access to MM03, so which is good news. So we'll show you. Okay, there are more questions. Thank you for using the Q&A. Does MEP should take only inventory which is actually in stock? That's a very good question. Yes, it does, because for inventory items, now I have to introduce the last concept of the morning, which is valuated versus non-valuated material. So thank you for the question. Now, I hope this explanation is more or less clear. So now when we acquire items based on the type of materials, we have two different type of materials. Ones that are called valuated materials and other ones that are called non-valuated. So for valuated materials are materials that has moving average price, that have a value in inventory. As soon as the items are sent out of stock, one second, please. One second, I'm going to just hold for 1 second. I need to get and watch one. All right. So I was saying that valuated materials are materials that have a value in stock. So if they are valuated, they will have a moving average price. And then as soon as they are and there is a good issue, these materials are sent out of stock and we are expending them, which means that any inventory item that is not in stock has zero value in the accounts. So it's considered as expense. So the moving average price will consider only materials in stock. Actually, if they issue out materials and after good issue, few days later, they return it back to stock, material will come as all supply, for example, and they will have no value in stock. So replying to the question that was, should MEP should take only inventory which is actually in stock? The answer is yes. It's considering only items in stock. So now I'm getting a bit some more questions. I guess it's about this scenario. So sorry, let me complete the picture. I'm saying valuated materials. So what are non-valuated materials? And this is also a bit complex, a bit confusing. Non-valuated materials are basically fixed assets. And why they are considered as non-valuated? Because the fixed asset will have its own value in FA subledger. So we are going to manage the value of the assets after capitalization and considering depreciation and everything. So a fixed asset, even if it's in stock, will not have a moving average price and will not have any impact in the account when they issue out. The value of a fixed asset is managed in fixed asset module, and we will cover it in a different session. So just keep in mind that fixed assets are considered as non-valuated materials. So when you process or when you see someone processing a good receipt, if they processed a good receipt for an asset, you will not see it in inventory. You will see it in asset account, which start with 271. I mean, that's a different story. We'll cover a different day. Give me 1 second. There are more interesting questions from you. Okay. So in case where the MAP is higher than the PO1 due to higher purchase period with result on reserve, how can we? Oh, okay. The voice is not clear. I'm sorry, but I'm recording. I'll try to speak louder. Now someone is asking, what if in the second, so in this scenario where we acquire 10 items at one price and then we have some items at different price. What happens if we acquire items with a higher price, right? Then what would be the impact? The impact would be exactly the same thing. The MAP will be recalculated. So in this case, we'll have a different MAP. So at the moment, so we'll have to, the system will post different amounts here. And then again, the system will recalculate the MAP and will recalculate it. There will not be any difference. If you do stock reservation, or if there is a reservation of material, it doesn't help you to avoid this, because the moment that the FI posting happens is at good issue. So even if there is reservation, only when the good issue is processed, you will be posting debiting the expense account with the moving average price. Okay, I'm sorry if you cannot hear well. Let me try something else. Can you hear me well? Can you please click on the green check if you can hear me well? Can you hear me? Please click on the green check if you can hear me. Yes. Okay. Some of you are experiencing audio problems, but as we did last time, we will send the recording. There is another question. MEP takes into consideration only inventory of the same type of inventory in general. Of course, MEP, you have a particular moving average price, so for every material. So every product ID will have its own moving average price. Now, what happens, and that's why we are having issues in inventory, is that sometimes, let's imagine now that we are in the previous scenario. So it's connected to your question, James. So if we have now, we acquired 10 items at $100, and then we acquired 10 items at $100. But now, let's imagine that someone is acquiring vehicles, and they don't realize they are trying to copy from a different. They are acquiring with a different shopping cart, and then they are copying or pasting from somewhere, and then all of a sudden they acquire one vehicle, and they select the wrong product ID. And this item, which is very expensive, it is an item that is costing, let's say, $50,000, $5,000, sorry. But this is wrong, right? This is wrong because they are acquiring something that is from a different material, but then they select wrong in the shopping cart the product ID. What would happen? This is terrible, because the first thing that happens is that in inventory, we will have this $5,000 for one item plus 8%. So the system will debit the inventory account with 5,000, right? Plus 8%. So we'll have a debit here of a very big amount that the system will consider is still the same type of item because they selected the wrong. So let's imagine that those are, I don't know, iPads or something, very cheap ones, tablets, and now they are mixing the product IDs and they selected the wrong one. So now it's was it 54,000? Yeah, 5,400, right? Which is exactly the price of the amount. The price of the item plus 8%. But now, if someone wants to issue out something, wants to issue now one of these tablets, what would be the moving average price then? What would be the moving average price? So now the system will calculate moving average price, and we'll have a big issue there, because the system will say the total value of inventory is actually 1,080 from the first 10 plus 540 from the second batch, and then there is 5,400 from the last item we bought. So this is the total value of the inventory. But now, if we divide by the number of items, we have 21 items. The system thinks there are 21 items of the same type because we selected wrongly. And now the moving average price is 334, right? So when they process good issue, they process good issue for 334, we said. Which is wrong because one tablet is about 81, right? So this is why the moving average price will be corrupted. So it will be 334. Now, when people realize that this is the problem, they will go and they will reverse this transaction. They will reverse this transaction. So they will say, oh, sorry, this product ID was not the correct one. They will reverse. So they will remove this entry from here. Okay. And they will reverse this. And then maybe the good issue also they reverse it. They reverse everything, okay? And they think the problem is solved. Is the problem solved? Can you please click on the green check if you think that by reversing we are solving the problem? Click on the green check if you think the problem is solved, because now we don't have this item in inventory anymore. Click on the green check if you think that now the problem is solved. Why is not solved? So if you say why is not solved, all right. If you say no, please tell me why it's not solved. If you say yes, I'll tell you why it's not solved. If after they selected the raw material, if you reverse, it's okay while you don't post anything. But the problem is that the moving average price is already corrupted. So it needs to be recalculated. Okay? It needs to be recalculated. So someone will have to go recalculate moving average price and define it as 81. Again, otherwise, we may have the problem of the system issuing out with the wrong moving average price. But it's not only that. If with the wrong moving average price, someone is sending stock to another mission, is sending the stock with the wrong price. So now I'm going to show you what is the official material and how you can solve it and who is identifying what's the best way to identify the error. Okay, so let me check. There are some more questions. For reversal of these transactions, they are involving finance. So PMU, which is have access to inventory managers, they are basically inventory managers. They will not be able to do it by themselves. So in the job aid, you will see that finance senior users or FA16 is involved in the troubleshooting. Now, give me 1 second. Now, at least, is it clear? Let me just recap what we saw, and then I show you the official material, and we close the session. So foundation, we used to have everything going to expense account at the moment of goods receipt. This is still valid for services, but for goods, now it's more complex. That's clear. Let me just recap. Then we saw that for goods, when they raise shopping carts, they can raise them for consumption, which is now an exception because most of it goes for inventory. So when they are raising shopping carts for inventory, at the moment of goods receipt, there is no debit to the expense account. It's debiting an inventory account. What inventory account? So the system now account determination based on product ID will get product category, and this will be posting to, in case of direct material, so it's for inventory, it will be posting the inventory account. All right. And then when items go to inventory, they are debited to inventory account, but not with the price, but it's price plus 8%, which is the standard associated cost. All right. Just if you agree with what with the recap, just click on the green check, so I know that there is nothing that you need me to rephrase. So they are considered in inventory as valuating material, and the system is keeping track of the moving average price. So when they are issued out of inventory, they are debiting to the expense account with the value of the moving average price. So it's debiting expense account for 81 in our scenario, and it's crediting inventory account for 81. Okay, so this is the, let's say, the standard summary. Okay, I think it's fine. Now give me a second that I read a couple of questions that are very good. Now for correcting moving average prices, I'm going to show to you one job aid that has all the information, so you can go through it and you will see that it's not rocket science. But if you don't have these concepts in your mind, you will never understand it. So thank you for the question, Bashir. Salvatore has another question. Exactly. So if there is already a good issue that has been posted with the wrong moving average price, it's mandatory to reverse the good issue. So let's say you will reverse the wrong posting, but apart from reversing the wrong posting, which will clean, let's say, your accounts, the moving average price, which is inventory concept, needs to be recalculated. So that's why I'm insisting on this moving average price, because you can clean, let's say you can clean your house, you can clean your account, but if we leave the window open, in the next good issue we'll have the same problem. So you have to be aware of why you have the wrong posting and fix also the root problem, which is moving average price. And on top of that, Chris Vicky used to say, fixing moving average price has to be very urgent. Because if there is a stock that you are sending from one mission to another, you may be corrupting the moving average price of other missions. All right, so this is something that has to be taken very seriously. Okay, and last question. The remedy for selecting the wrong product category. Okay, yes, so let me clarify that. The starting point of the problem is the shopping cart. Now, requisition has been training have been trained for a long time on selection of the right product ID. But if they select the wrong product ID, is where the problem starts, because then the system in inventory will be mixing prices from two different items. So if you and then inventory managers, they have instruction not to post any good receipt if the product ID is not the right one. Okay, so but if it happens, this is the impact. And then there is some job aids to fix these downstream problems that I'm going to explain to you. Okay, yeah. So basically, it's coming from the wrong product category. So it's selecting the wrong product category. Okay. Now, I'm sorry if you are having, again, audio problems or networking problems, but I'm recording the session, so you will get it, and you can just skip my bad jokes and go to the information that you are more interested in. So what about official materials? Because I couldn't create new materials, and the existing materials are actually very good. So now, please pay attention, because this is a very, very important part of the session, okay? And I see that not everybody is paying attention now, because I have an indicator that tells me that some people are not even looking at the screen I'm sharing. So 1 second, so please be with me, because I want to show you where is the information that you want to check, the official one. Okay, I'm happy that some of you are now getting up. So if we go to the normal Umoja website, umoja.un.org, okay? And then we go to job aids. You have here very important section for finance that most of you are not aware of. There is here the posting schemas. So if I can annotate, let me just 1 second, so I highlight it. So you have here the section that says posting schemas. Okay. You have to, you should open this one and download it. So in case you want to understand what is going on, it's a very good point. So if you open the posting schemas link, okay, you will get a spreadsheet that I already downloaded, so I'm going to open it. Okay, sorry, you first get to this section. The posting schemas will have all the posting for all the transactions that are related to fixed assets or inventory. For fixed asset, we will review it the following days. For inventory, you have STO processes, very interesting for you, and we have LE99, Logistics Execution 99, which has all movement types. This is like gold for you guys because it has all the postings based on that inventory managers can trigger based on the movement types. So if I open the spreadsheet, let me just drag it here. So I'm going to send you also in the attachment to this email, but it's better if you go to the official reference because sometimes it gets updated. There was another question about moving average price. Someone is asking if the MAP is corrected automatically. If it gets corrupted, it's something that you have to fix manually. And now I will tell you where is the job aid that tells you how to do it. Okay. Now the question if the MEP is recalculated when the good issue is reversed, you have to consider that the good issue is not affecting the moving average price. The moving average price is changing when you acquire new items. So if you do the good issue with the wrong moving average price and you reverse the good issue, you will not fix anything because good issue is not impacting moving average price. If you have 10 items, each of them with moving average price 334, if you issue out one, you will have 9 items with the same moving average price. The moving average price is affected by new good receipts. All right? Is this clear? Okay. So this Excel is very, very good. Has been developed by Chris Vickery from Ammaji team, and is an excellent summary for FI stuff. So if we are talking about normal good receipts, you see here, if we are acquiring normal items, inventory items, you see this section here, you'll see the posting. So when there is a goods receipt, which is MIGO, and this is the movement type that inventory manager selects. Movement type is just a number that they select and will be driven the posting. So if someone is doing good receipt with movement type is 101, the system automatically debits inventory account, credits the GRIR account, and credits the freight services. Do not get confused now with this 4% because for peacekeeping, the standard associated cost is 8%. For other agencies, it's 4%. So peacekeeping is 8%, other agencies is 4%. But the concept is pretty much the same. And you have the posting here. You can take a look also to the FI integration side, to the FM integration. You can check everything. Now this is the posting that I was explaining to you for good receipt. But if we have a good issue, for instance, you can find a good issue, okay, from inventory, the normal one that is like to non-budget relevant good issue to cost center will be this one, will be the standard one when we are issuing out materials to the same cost center that was acquiring them. And here is the accounting: debit to the expense account and credit to inventory account. So here in this Excel, you have all the posting that you can get from MIGO code, so from inventory transactions. Right? Then you have some reference to SAT materials. If you read SAST materials, this is referring to fixed assets. So we will see it in the future days. So, but please, one of the main messages, use these posting schemas to understand what's going on. If you have a posting or if you realize something has been posted with a different movement type, because it's not only good receipts and good issues. You may have return to stock. You may have addition to stock. You may have something that is going from block stock. So the example that I gave to you is pretty much the general one. For items, there is another question from James. For items that remain in inventory status unexpired, there is counting and controlling, and I think there is also revaluation of stock. So those are different processes and their property management, and then they will have different transactions that will be, let's say, sending the elements to expense accounts. Okay, for one of the following sessions, I may invite one of my colleagues that has more background on the inventory side. But yeah, those will be different processes. This is one of the job-based section that I wanted to explain to you or to give you information. Please review movement types and at least get an idea of the standard processes. You have also here the posting when it's issuing out to a project, when you are issuing out to an asset under construction, when you have something related to cost recovery. So everything is written there. Another job aid that is very important for you is this one. It's under financial accounting and it's called Overview of Ammaji Inventory Accounting for FI Users. You should get this job aid and read it carefully. Maybe not all the sections, but if I open the job aid, you will see that it's an excellent job aid that Chris Vickery produced. And you can go to different sections to get a better idea of the concept that we explained. So for example, if I do a quick review, you have explanation of materials management in Umoja, valuated materials versus non-valuated, what I said. Non-valuated materials, for instance, the fixed assets. Valuated material, what goes to inventory. Explanation of what is different, what is going to consumption versus going to inventory as direct material. You have explanation here, a very good one, about the process. When you acquire for consumption, everything goes to expenses. When you acquire for inventory, you increase quantity of inventory and you increase inventory value. And you are debiting inventory at the goods receipt. When you are acquiring fixed assets, for example, you are increasing quantity in inventory, but you are not increasing inventory value because the value of the asset is managed in the fixed asset year. Sorry. So this is a very good job aid. One more section that you have here, you have sections about MAP adjustments. You have examples of what is the posting for the goods issue, the posting for the goods receipt. So this is basically what we saw already. We are doing goods receipt, and then we are debiting inventory account, we are creating GRIR, and we are creating the freight standard cost. So if you have any question or something that it was not completely understood, go to this job aid that I'm going to send and use it. It is great. Everything you need to learn, it's very well detailed here. Now, another job aid that is important for you is this one that says MAP Valuation Adjustment. So if, for instance, you have a situation where you have items that are they need to be reviewed, the moving average price, here it's also very detailed. So this job aid will tell you how to adjust material prices, and this also is involving finance, and you need to work in collaboration with inventory managers. So here it is explaining to you the concept of moving average price. There are some particularities regarding financial inventories versus non-financial inventory that I didn't cover that much in the session, but here is explained. So there is some type of inventory that needs to be, let's say, at the end of the year needs to be expensed, and so there are some adjustments at year end. But yeah, I would recommend you to read this. Okay, of course, this session today was only for a kind of summary or introduction you to the integration, but we could expand much more. But this is reference material for you. And something else from the job aid section. One moment that the browser is getting stuck. Okay. Yeah, of course, I would recommend you to download the job aids, because if you open them in the browser, they are sometimes they are too big. And then there is yeah, there are some sessions when you have to do some adjustments at the GRN. So this is all explained very well on this job aid. So if you are involved in this, it's fine. Otherwise, let me just open the final another job aid. 1 second. So we are closing the session. Okay, here it is. So let me go back. Okay. So the last job aid that you need to mark as interesting for you when it's regarding the inventory management is this 3 job aids, or this big job aid in 4 parts, which is called SRM downstream issues correction. So some of you were asking how to fix this situation, etc. So if you have a problem in your moving average price, or some product ID was wrongly selected and it's not possible to reverse, let's say to cancel the shopping cart and raise it again with the proper ID, which is the recommended situation in this job aid, you could check the process to fix it. So it will tell you, okay, what actually happened, and it's asking you what happened. We selected the wrong material ID. So you have all the scenarios. They selected SAS when it should not be SAS. So they selected for fixed asset, or they selected for a non-SAT, but it was the wrong one, but it was different product category, etc., etc. So everything is pretty much here, and those are the job aids that I'm going to attach them to an email, so you get them through email. But please keep on checking, and this is a general advice: keep on checking job aids and then see what is new and is from this year. For instance, there is always, you see, has been updated in February 2018. So also in financial accounting, you will see some job aids that have been updated in March 2018. So it's very important that you get an idea. We didn't cover the part of the STO, and it's also something interesting. You can check also the posting schemas, and maybe I'll cover it when we talk about fixed assets. So we will cover also STOs, but there is also a job aid here of how to do the clearing of this particular GL that is impacted also by inventory transactions. Now that was what I wanted to cover. I'm sorry the session went too long because I wanted to keep it shorter, but if you have any other question, I'll be happy to address it now, or if you want to send me by email, I will reply to you today. All right. Otherwise, okay, there is one question. All right. If you have not received, if you didn't receive the link or material, please send an email to Moya DFS training. So one of my colleagues will take this. You will receive an email today. So I'm just going to reply to the meeting invitation and add these PDFs. Right. You don't need to, there will be an assessment at the end of the week, but you don't need really to, let's say, study all these documents. This is for your reference. And I will just send you the PowerPoint I was drafting when I was talking to you, so you can just take a look to these concepts. The purpose of this session is basically to give you a refresh, to let you know what things have changed in case you were not aware, and to let you know what is the official material that you should have checked to be, let's say, up to date about these topics. I really hope this was useful for you. We took the initiative and we decided to give you these sessions and to bother you a bit of this Monday morning, but I really hope this had some value for you and will help you when you get people asking you about inventory problems that you have to be involved for the fixing. Thank you so much for attending this session. It was a pleasure once again to be in contact with you, and please do not hesitate to write to us if you have any other comment. Thank you so much. I'm happy if it was helpful, and I'm happy to see that we had about 120 people connected, which is, I think, the message will at least reach the missions. Thank you so much. Have a good day, and talk to you tomorrow. Thank you everybody. Thank you. You are very kind. Thank you so much.